Before you invest a single dollar in 2026, understand this uncomfortable truth. Most people don't lose money in the market because the market is dangerous. They lose money because they are impatient, ignorant, emotional, and addicted to stories instead of numbers. And Warren Buffett has spent more than 7 decades quietly profiting from that weakness, not by predicting the future, not by chasing trends, not by reacting to headlines, but by doing a few brutally boring things with extreme discipline while everyone else panics. And if you don't adopt this mindset before you invest, you are not investing at all. You are gambling with better marketing. Buffett's real New Year strategy for 2026 starts with a ruthless self-audit, because the first investment decision is not which stock to buy, but whether you are even qualified to buy stocks at all, meaning, do you have an emergency fund that covers at least 6 months of expenses? Do you have high-interest debt that should be eliminated before market exposure? Do you understand that markets can drop 40% without warning and stay down for years? And can you emotionally survive that without selling? Because if the answer to any of these is no, Buffett would tell you to stop immediately and fix your foundation. Not because he's cautious, but because he understands that leverage, debt, and desperation turn small market downturns into permanent personal disasters. Next comes what Buffett would call your circle of competence, a concept most people repeat and almost nobody respects, because it means you must admit what you do not understand. And in 2026, this matters more than ever since AI, crypto narratives, biotech promises, and geopolitical fear cycles will flood your screen daily. And Buffett's rule is simple and cruel. If you cannot explain how a business makes money, what could kill it, who its competitors are, and why customers stay loyal in plain language without buzzwords, you do not invest in it. No matter how smart the CEO sounds or how exciting the future appears, because the market does not reward intelligence, it rewards correctness over time. After that comes valuation, the most ignored step by beginners who confuse a great company with a great investment. Because Buffett doesn't ask, is this company amazing? He asks, is this company amazing at this price? And in 2026, when narratives will inflate prices faster than fundamentals, this distinction will separate investors from exit liquidity, meaning you must compare price to intrinsic value using conservative assumptions, not optimistic projections, discounting future cash flows with realism, not hope, and demanding a margin of safety that protects you from being wrong. Because Buffett knows you will be wrong sometimes and only fools assume otherwise. Another brutal Buffett truth for 2026 is this: diversification is protection against ignorance, not a badge of intelligence, not compounding. Speaking of compounding, Buffett would remind you that time is not a market feature. It is the most powerful asset you own, and every unnecessary trade, every emotional reaction, every attempt to optimize returns through timing destroys compounding quietly. Meaning the real enemy in 2026 is not volatility but overactivity, because inactivity with high quality businesses often beats cleverness with mediocre ones. Buffett's New Year discipline also includes ignoring macro noise almost entirely, not because it doesn't matter, but because it is unpredictable and uncontrollable. And anyone claiming certainty about interest rates, elections, wars, or recessions is either lying or delusional. So instead of asking, what will the economy do in 2026? Buffett asks, will this business still be relevant, profitable, and dominant 10 years from now? Because long-term business economics overpower short-term macro chaos. Another principle people hate but Buffett lives by is capital allocation, meaning great businesses with terrible capital allocation can destroy shareholder value, while decent businesses with intelligent reinvestment policies can outperform. So in 2026, you must examine how management uses cash. Do they reinvest at high returns, buy back shares intelligently, reduce debt, or chase empire building, acquisitions that look good in press releases and terrible on balance sheets? Because Buffett follows incentives, not charisma. He also warns against complexity, because complexity is where incompetence hides. And if a business requires 30 assumptions to justify its valuation, it is probably a bad investment. Whereas simple businesses with predictable cash flows may look boring but often outperform over decades, which is why Buffett has no interest in impressing anyone at dinner parties. Emotionally, Buffett's biggest edge in 2026 remains temperament, not IQ, because markets will test you with fear, envy, regret, and boredom. And if you check prices daily, compare returns obsessively, or feel the urge to act just to feel productive, you are already losing, since Buffett's strategy assumes you will do nothing most of the time. And doing nothing is psychologically painful for people addicted to stimulation. Finally, Buffett's New Year investment philosophy ends with humility, the understanding that you don't need to swing at every pitch. You don't need to be right often. You don't need to be early. And you don't need to be exciting. You only need to avoid stupidity consistently, because investing is not about brilliance. It's about survival plus patience, and in 2026, when noise will be louder, speed will be faster, and narratives will be more seductive than ever, the investor who wins will not be the one who predicts the future, but the one who prepares for uncertainty, buys quality at sensible prices, holds through discomfort, and lets time do the heavy lifting while everyone else looks for shortcuts that don't exist.